So today I'm catching up with an expert in the financial advice industry. His name is Tony Walker, and I'm going to have a open, honest, upfront, candid discussion with him. I hope you enjoy this one. Please like, subscribe so that you can see more of these in the future. Let's get started. If I was just to think about a typical client that I would see in a typical week, some of them will be DIY investors that do need some guidance. And that's really all they need, right? They need to know, what is my asset allocation? What mix between growth and income? Give me some clues as to what I should look out for, and then off I go. Then there's another type of person that I'll deal with who will either be overwhelmed by the size of the money that they have to invest in, and that feels quite full on, or they are overwhelmed by the choice that they have. There's something that I need to do. I need to go a little bit further, not just, hey, let's talk about this at a strategic level and what is right for you, and then off you go. But okay, we've identified that you're probably not the right profile of investor to go out there and do it yourself. You do need a little bit more guidance. Therefore, let's take it the next step. But before we get there, I want to pick your brains around, generally, as people approach a lump sum of money and they think about this, like ideally at the start of retirement, so let's say you're 65 years old, what are the first things that you ought to think about as the investor around how I should invest this money?
Liquidity and keeping things simple. You know, by liquidity, I'm talking about how quickly you can convert to cash. Investment in property is not liquid. As people get older, what really all they need is cash. You know, so the investment, it becomes a means of generating cash. So if you can't get the cash, you've got a problem.
The bigger your investment account, or the more stuff you own, the more it feels like you have lots of spending power, but you don't, because of that liquidity issue. Like if 99.9% of all of your wealth is locked into assets that can't be converted to cash quickly, you really don't have those assets, because
that's right.
When you need it, they might not be there.
If you say, well, I want to do more travel when I retire, which is a very common one. I don't know quite why that should be, but people do. Air New Zealand won't accept an IOU for an airfare.
I've noticed that, yeah.
So you put it on the credit card, which is fine, but you got to then pay off the credit card, or else you're paying 20% interest to the bank. So, you know, having those liquid funds. Now, in my experience, that tends to create a bit of a mismatch, because people tend to think, oh, I've got to have the money in cash. So they have a significant chunk of cash in a savings account. Bank says, that's great. You know, we love people who've got cash in the savings account, because we don't have to pay them much interest, and we can lend that money on and make a good profit from them. They're nice people, you know. Term deposits, bit in the middle. A 5-year term deposit is not very liquid. A 3-month term deposit is quite liquid, you know, because most people can project out 3 months. But that may not be the most efficient way of handling the money. But I think the industry has got very good at overcomplicating this investment liquidity issue.
Okay.
Because we hear people talk about, you know, pots, short-term pots, medium-term pots, long-term pots. But what's wrong with having a pot that you draw down on? Let's just say that we've chosen to invest the money, and by the time you get to retirement, most people are more concerned about preserving the value of their investments than growing their investments. It's nice to get a bit of growth, but really you don't want to lose your money. So, you know, the asset allocation does change. People's comfort with risk changes, and you wind down the dial. And you might finish up with a moderate portfolio or a conservative portfolio. But if you have all your money in that portfolio, most fund managers will allow you to take regular withdrawals.
I think that's something that is a detail which is so obvious when you're in the industry and you understand that, but when you're a consumer, you don't.
Mm-hmm.
You don't understand that if you have a pot of money sitting in an investment account, you can flick a switch and convert it basically into an income stream, an annuity.
Yep.
And it just feeds you a portion of investment returns and capital distributions as you go.
We were always trained to talk about dollar cost averaging on the way in.
Yes.
Well, now we're dollar cost averaging on the way out, because when if I want $5,000 a month from my investment portfolio, the manager looks at the unit price and says, how many units do I need to cash up in order to generate $5,000? Now, when the unit price is up, you cash in less units. So it's a dollar cost averaging exercise on the way out of the investment when you've spent 20, 30, 40 years dollar cost averaging in. Now, to me, that makes perfect sense. So I don't need to have a cash bucket and a medium-term bucket and a long-term bucket, because it's all happening within the bucket that I've got. And it has so it ticks the liquidity box, because I get my money. And if I want $20,000 for an overseas trip, I just let the manager know that next month I'm going to need an additional $20,000, and I get that. There's one thing to think about. I don't have all these things all over the place that are complicating me and confusing me and becoming tax nightmares, and my life is simple. And eventually, it's simple for my family when it's time for them to manage my affairs. Do I want to help my children out to buy a home? Do I want to set up an investment fund for my grandchildren? Now those are not related to my investment, but they're still important to me as a client with this pot.
Can you take me back a little bit around the relationship between volatility, like how investment returns can be uncertain in the short term, and therefore why we don't want to invest money that we're going to be spending over a really short period of time?
If we want to cash in an investment at a particular time and the market has gone down, we lose. But predicting where the ups and downs is really hard. Now, statistically and practically, there's ways of managing volatility to load it a bit more in the client's favor. The blended portfolio, the mixture of growth and income assets gives you a better risk-adjusted return. So what I mean by that is that the return you get in proportion to the risk you take
is maximized,
is better. Many investors only need one pot.
Wow. If you had a pot of money that you really were going to be consuming within, say, 3 years, should I be investing that, or should I just put that in cash and a blend of term deposits? What would you say?
Well, the best way to leverage the system is to commit the money for as long as you can. But if you want to make sure it's going, the value you get out the other end is going to be predictable, then some form of fixed income investment is really the way to go. And term deposits, bonds can be affected by movements in interest rates, whereas term deposits aren't.
And that's a really important differentiation, right? So there's an inverse relationship between market interest rates and the value of your bonds. So even though the returns might look good on paper and it's called fixed interest, sometimes term deposits are really the only risk you want to take within a short period of time. And there is still really risk, right? Because what happens if your needs change within that short period of time? You effectively could sacrifice the return that you were going to get, and it was a waste of time doing that.
Yep. Term deposits are, there needs to be a bit of financial planning goes on to determine when the money is going to be needed, and if there is some uncertainty about that, then a very short term deposit of 1 month, 3 months, something like that, or even just a on-call account will probably need to be the way to go, because you then don't run the risk of foregoing what you thought you were going to get.
Exactly.
By
or
having to break the
facility.
deposit.
Yeah, like if you had a mortgage facility and it was you could convert it into a revolving line of credit, dump all the money in there.
Oh, well, look, I think the revolving credit facility is not well understood as an investment option. It's understood as a mortgage option, but it has, I think, a very powerful investment capability.
You want to break that down as to why?
If it's possible.
Yeah.
Well,
so assuming it is, let's just say hypothetically you had $100,000 and we have this dilemma. We have 3 years to go before we're going to, up to 3 years to go. We don't know when though. We have up to 3 years to go before we're going to need this $100,000. You have a $500,000 mortgage, but you have the ability to implement a revolving line of credit system to park your money in there. Why could that be something to consider?
If you have a mortgage and you have surplus funds, so you have debt on one side of the equation, you have surplus funds on the other side of the equation. Now, if you keep those funds separate, so you have your debt, bank wins. You have your surplus funds in cash or a short-term deposit, bank wins. Okay? If you can find a way to move those two together, it may just be able to be a bet. It may just load the dice more in favor of the customer and less in favor of the bank. The bank won't lose, but the customer will do better. And the reason for that is that the interest rate you pay on a debt is paid from money that has been taxed. So if you compare interest rates, you actually get a very good return on the money if you pay off debt.
Yeah, which is, it's a little bit of mental gymnastics, but it makes sense, right? Like if you're servicing those interest payments with your after-tax income, then you really have to adjust it for that to determine what the effective return is on your money if you were to pay down that debt, which I think is really interesting, because then you add another layer on top of that and you consider the risk. But you're not there is a little bit of a risk there, which we'll come back to, but you're not really taking a risk by paying down debt, so long as you can take it back out again.
Well, no, that's absolutely right. In fact, if you pay down debt, even if you're going to take it out again in the short term while you've paid it down, you've actually de-risked your life. So you've actually reduced the risk by doing that.
Yeah.
So it's in my opinion, it's a very compelling argument, which is often not an argument that is told by the lending institutions.
Well, where's the revenue model for that, Tony? Right?
That's right. That's
where's
right.
The incentives?
That's right. But this is what I mean about bank wins. Maybe financial advisors, independent financial advisors, one of their roles is to help customers to play the banks at their own game. The system can be used more efficiently. Why not?
We have the technology, and they're making it easier. Offset mortgages, revolving line of credit. But I guess if you think about the underlying incentive structures, the banks and even the mortgage advisors who implement those mortgages, they're getting often, not always, paid a small commission based on the outstanding balance. Yeah. So are they really incentivized to do that? I know a lot of mortgage advisors who do this, so I don't want to imply that everybody wants you.
Not at all, no.
Yeah,
no.
And same thing with bankers, right? But there is no commercial incentive to that. These people are doing it because they want to be good at their profession.
Because it's the right thing to do.
Which is awesome. In a perfect world, which I know is unattainable, I would love it if the commercial incentives were always aligned to doing the right thing, but it isn't. And that's why you need this other layer to actually make sure that behavior stays within certain guardrails. But just going back to this idea, though, so we have short-term pot of money, because one of the number one questions I get all the time is, where do I invest this money? And then the next question is that I have for them is, how long will it be before you need some or all of that money? And if the answer is, and it often is, within 3 years, it's not an answer that is welcomed when I say, well, we really shouldn't be investing this money. We should be figuring out really efficient forms of saving the money.
Well,
How can we protect it?
You are investing it, because even if you put it in a term deposit, that's an investment.
Sure. Yeah.
So it's just your choice of investment is different.
Sure.
And it comes back to liquidity, because liquidity is how quickly can you get the money if you need it. Now, I always used to have a slightly nervous judder when somebody said, "Oh, within 3 years," because what I experienced this several times with clients, is that within 3 years actually meant 3 months. They thought they were going to, and especially with property,
I know, yeah.
We'll buy a house within the next 3 years. Well, that's great, and that's our plan at the moment. And then we've seen something and we've fallen in love with it, and we want to buy it, and we've got to complete within 3 months. So an investment decision with a 3-year time frame was suddenly wound back to 3 months. And then if you'd gone for the long play and you suddenly found that you couldn't get the money after 3 months, you were not going to be the friend of the client, but the client had changed the rules on you, so I think I became very much of the view, err on the cautious side. If they say within 3 years, they probably don't mean that. If they say, well, it'll be at least 3 years, we've got to wait while so-and-so finishes their education. Okay, well, that was sort of a bit more predictable. Wasn't totally predictable, but it gave you a little bit more confidence that there was more likely to see out that 3-year time.
I hear you. Like when serendipity occurs, like the house down the road just showed up out of the blue, right? Different story. When it's waiting for this certain event to run its completion, then we will be able to. Different story. Yeah, so it's about kind of really, again, it comes down to the planning, right?
And understanding the client. You know, if I'm an investment advisor, really what I want is this person to invest the money with me for a while. So the client is probably going to say, oh, I'm going to invest it for 3 years or 4 years or 5 years. But for many people, 3 years, in that midlife area where there's stuff going on all the time, jobs and children and houses and businesses and so on. I don't know what's going to happen next week, let alone in 3 years' time. So it's anybody who says, oh, we'll invest this money for 3 years, be careful, because they probably won't. Now, I can't imagine that clients would be upset if you said that to them.
No, well, in my experience, they haven't been. However, sometimes there is some frustration because they're hearing about things that are occurring and whatever the market is, and they want to be in that. And to be fair, like often it'll happen in markets which aren't like the market that we're in right now when it comes to property. Like right now, we're actually seeing the consequence of using property as a short-term store of wealth. Because as we've seen, especially adjusted for inflation over the last 5 years, property is not a very good short-term place to park your money. And so that's all. But with the share market, and this is true with most managed funds, it's not like people have been losing money in the share market over the last 3 years. Well, there's been times, right? But it's hard to talk people out sometimes, I find, of wanting to invest when they know that, well, they're advertising 8.74% or 9.32%. Why don't I just go for that? Because it says that per annum, without understanding that that is based on a lot of assumptions, right? So sometimes it's hard for me anyway to talk people out of doing it, and it feels like I'm pouring cold water on their ambitions.
Well, I think, to some extent that's your job. And if they don't like it, then that's okay. They're allowed not to like it. But you, are being professional. You're allowing yourself to sleep easy in your bed at night knowing that you haven't put somebody in an impossible situation. Now, I saw in the global financial crisis, there were so many impossible situations that people had found themselves in. And it's horrible. It really is horrible, and that really taught me a lesson. I never want to be in that situation with clients.
That gives me nightmares just thinking about it, right? Because you never know when events will happen,
No.
Whether it's the GFC, the 87 stock market crash, March 2020, you name it. There's always going to be a catalyst, and that will trigger either a once in a cycle correction or a once in a lifetime dramatic share market meltdown. And no matter how professional you've been as an advisor, you kind of feel like you're the easy target. You're the easiest target because you're the one who put themselves out there and said all this stuff. And it's a no-win situation. I think that's kind of, when I look at newer advisors that are trying to get into the industry and want to get into the industry, I don't think they appreciate just the weight of responsibility that there is when you worry, because I worry all the time about stuff like this. It doesn't necessarily change the way I'm giving advice, but I worry about it because these are lives that I can understand and relate to. And I know that this money is going to be powering these families. And so if I'm now aware of a meltdown that's occurred, I know there's so much pain out there. And it destroys me sometimes. So I want to make sure that I'm giving the best advice, but also I'm acting in a way that, like you say, makes me sleep at night.
Well, winning by not losing. And people lose money in investments by making wrong decisions, by being unlucky. But a lot of the time, those mistakes are avoidable had the research been done more thoroughly, had the situations been understood better, had products not been just pushed in front of people's noses. I'll give you an example. There are investment schemes which are promoted where people are encouraged to borrow money against the property that they live in to purchase a rental property. They're all based around numbers going in a positive direction. But numbers don't always go in a positive direction. And I've seen quite a number of people over the years who've not only lost their rental property, but been forced to sell the home they live in to keep their head above water in a situation like that. All their equity is wiped out. They've lost their investment. They've lost their home. Now, for some people, that may be a perfect strategy. But if one of the breadwinners loses a job, for example, that can very quickly unravel.
Yeah. It's not a perfect science, though, right? Like that's why I always come back to that. There's always the market.
Never.
But you're right. Easy wins are follow a good process and use a trusted advisor. Definitely. So thinking, though, going back to what we were saying before, simplicity, and let's just say not the brand. Sorry, Sam Stubbs. Keeping it simple. Let's just use that phrase. So let's keep it simple with everything else. So if there's money that shouldn't be placed at risk, then don't put it into anything that is illiquid. But let's assume now we have just one simple investment. Give it to an investment advisor or a fund manager. You don't really need to worry about it. You're effectively giving them a mandate. Pay me X amount per month. The rest of it is their job, right? But when there's a blend of DIY and DFY done for you, how would you approach that idea where an investor says, I'm happy to give the investment advisor 80%, but I want to take this pile over here and invest it according to my own strategy? How would you approach that, or how have you approached that in the past with your clients?
Well, if you're talking about somebody who's retired here now.
Yes. Yep. So going back to the 65-year-old, they have a pot of money and they want to make it last until their end days.
The first thing that the investor has to, or the client has to realize, is that there will continue to be a cash requirement, because retirement from a financial point of view means my investments have to pay me. I don't have any income from work anymore, so my investments have to pay me. Now, where's that money going to come from? Is it going to come from the 80% that's managed, or is it going to come from the 20% that I'm managing myself? So it doesn't really matter, but it's got to come from somewhere, because if it doesn't come from anywhere, you're going to starve. Holistic financial advice should look at the whole picture. Mm-hmm. If you've got that mixture, what you effectively got is at 20%, which is out of the control of the professional.
Yeah, exactly.
And that can be difficult, because if the advisor doesn't have access to information, how do you really know what that 20% is doing? I mean, if you've got 20% of money that's well invested, it could be brilliant. If you've got 20% of money that's poorly invested, or, put at significant risk, it could be a disaster. So I would be sort of having this conversation with the client and getting him to understand how that split complicates the advice process. It's not impossible. I mean, most platforms do have the capability of including non-custodial assets, but it does come with a warning that those assets won't be built into the analysis. And I think sometimes the clients don't fully appreciate that. Alternatively, you could say, well, look, you take if this is an itch you want to scratch, you want to set up a share account and manage it yourself, good luck. You will give you some play money, but the bulk of the money will be there to provide this income that you and your partner have told us that you need for the rest of your life.
Yeah. And some people that need to scratch the itch will knowingly be scratching an itch, and that's okay. And they understand there'll be wins, there'll be losses, and you might not necessarily outperform the investment advisor. In fact, the investment advisor has a completely different mandate as well, because they need to make sure that they are using all of their skills to deliver on what you need. Whereas with your smaller amount of money, which you're not necessarily as dependent on, you have a little more freedom. And so your risk appetite might be higher. Therefore, your volatility or your range of returns will look more impressive in some seasons than others. And so it does kind of create a bit of an unfair reference point, or not an unfair reference point, but a potentially risky reference point, in that, I guess, if you self-manage a portion of it and it does exceedingly well, you might go, well, I'm going to take out more now from your pile of money, and I'll do it myself because I'm really good at it. But that's volatility, not skill sometimes, right?
I mean, I think in my opinion, the question that retired people should be asking is, will I have enough money to buy the groceries? When you get this competition, the question becomes, who's given me the best return? Now, in order, as we talked about earlier on with volatility, in order to go looking for big returns, you've got to take more uncertainty. And if that uncertainty actually backfires on your ability to get cash, then ultimately something's got to give. And as long as I, as an advisor, can continue to deliver the cash that you need to pay your bills and take your trips and help your grandchildren out, then I've done my job. And the return really isn't that important. Now, obviously, if there is some question about whether the money will last the course, then that becomes, that changes the discussion slightly. But I would go back to what I mentioned earlier, is err on the cautious side. Don't do a model with a 8% return. Do a model with a 5% return. Now, one thing that I think is worth dropping into the conversation here is that I think a lot of people don't understand the difference between actual return and real return. And by real return, what I mean is inflation adjusted. So are we protecting the purchasing power of your money? Will you be able to buy the same groceries next year as you can this year? Because ultimately that's what's important. And so looking at the nominal return, the stated figure, doesn't always tell the story. I mean, we've been through a period, in the last couple of years where inflation got up to 5-6%. Now that can be very corrosive.
So when people are kind of looking at their returns And then this is probably like really true again with property. No one really ever does the maths behind the scenes,
No,
but
absolutely.
it's been a terrible hold over the last few years.
Yeah.
And that's assuming that the CPI, the Consumer Price Index, accurately captures inflation. And I think there are certain seasons in which CPI is lower than real inflation and higher than real inflation, just because it's measuring a very selected group of things in that basket. And when you get older, things like medical treatment, good. You have a look at your medical insurance premiums from year to year. I'm not sure whether you know your age, whether you're continuing on with that, but
even at the moment,
yeah, good on you. Like at my age, 20% a year.
Yeah,
I mean, that's massive. But I see medical insurance premiums as, ironically, one of the ways that you can manage your own personal rate of inflation, because you're going to be using medical services so much more when you're older, I think, especially if there's a risk that
I think
you get sicker sooner or the medical system can't handle it, right?
I think that you're right. It's medical inflation is not related to consumer price inflation at all. But, we hear people talk about, inflation in house prices, insurance premiums, rates. The CPI is an attempt to average out a lot of these, but it's not a perfect measure by any means. But it generally gives you a feeling of, a price is going up more or a price is going up less,
Mm-hmm. Yes.
I mean, if we'd done butter inflation in the last couple of years, we'd all go and shoot ourselves probably.
It's not worth dying over butter.
No.
Guns and butter. Now I see the connection. So thinking then ahead, if I was a 65-year-old, I had a pot of money right now, and I was really confident with my spending. I knew how much I was going to spend. Really, it's just an exercise of maths, right? Like we know, like if you know what your budget is and you've got a rough feel for some of the events, like going on a trip, renovating the home, selling a home, downgrading, helping a kid out or two with a deposit for their first home in 5 years, whatever the story is, it is knowable, isn't it? You can plan for this, and therefore you can then choose, or an investment advisor could choose for you, which investment types to invest in, right? So what would you say to someone who's kind of grappling with this for the first time? Like if someone's listening or watching and they have a pot of money and they're at that time to retire, what would be the first thing that you would suggest that they should do before they've reached out to anybody at all?
I would start to think about what's important to me, you, us in our life. What's important to us? What do we want the future to look like? Get some idea. You doesn't have to be minute detail, but just get some idea of what are some of the things that we're going to want to do. Because if we know what they are, then we can sort of come up with a bit of a costing approximate. A lot of this is guesstimate stuff. It's not absolute numbers, but we can have some idea. Okay. So just get an idea, because that's what a good advisor is going to ask you. So, if you go into a meeting with a financial advisor and the first question you get asked is what's important to you, and you haven't thought about it, you're unprepared. So prepare for it. Prepare for the discussion. But the next thing I would say is commit to finding somebody you trust. Now, how do you do that? Well, there's a number of ways, but one of the ways that I think is pretty helpful is ask yourself, is this person interested in me? Are they listening to me? Or are they talking about themselves all the time and telling me how wonderful they are with their investment management and how great returns they're going to produce for me? Or are they just saying, tell me about you and your family, what drives you, what are the important issues in your life? What are some of the things you want to do? And then they let you talk. Now, eventually you will reach a point where you say, yes, I trust this person. Or, well, I don't trust them. And if I don't trust them, go and talk to somebody else. I think the worst mistake that a lot of people make when they reach this retirement age is they don't trust anybody. The world is a bad place. I don't trust anybody. I don't trust. So I'm always fighting. And you can't function on that basis, because as you get older, your financial advice needs change. And you need somebody who can, an advisor who can change with you. Now, if I'm going to talk to an advisor today, I'm probably talking about a relationship, and I'm 65 today. I'm probably talking about a relationship that could last 20 years. Not 5 minutes, so yes, things go wrong. Yes, people need to make a change. But in principle, what I'm doing is I'm setting up a 20-year relationship here. So I've got to trust that person. I've got to feel that they are there for me.
That's such an important thing. And in a lot of ways, I know for me personally, professionally, I've been preparing my entire life to start my career like pretty much right now. And it's true. And I know that I can probably handle somewhere between 1 to 200 good professional relationships with clients that I'm going to serve and their families between now and when I one day retire. And so it does require a mindset on both sides, right? A committed mindset that it's not a one-off interaction that you're chasing at the best possible price. It's in a weird way, it's a committed relationship, right? Where you'd want to stalk that person for a while, right? In a not creepy way, like figure out who they are, what makes them tick, what's important to them as well before you reach out to them for advice and input into your life. Are they the type of person? Do they have the values? Are they willing to go there?
Yeah.
Not everybody will gel with me for sure. And that's a good thing, because I won't gel with those people either. And that's why it's good that we're dealing with people here, right? Not algorithms.
And this is, I think, where, as technology evolves, good financial advisors are really going to stand out. They're the ones who, they get the people bit. They're good at creating and maintaining relationships that are built on trust. And really everything else can take care of itself, So you mentioned the word values. I think values are huge. And if my values are different to the values of my professional advisor, eventually we're going to come to blows. There's going to be friction. But if we broadly agree on, how the world looks and how we function in that world, then we'll be fine,
Yeah.
And if they care, if they take an interest in me, that's pretty good, I think that's important. And I think, days when I was working as a financial advisor, I coined the phrase that the clients get the financial advisors, the clients get the financial advisor they deserve. So it's not a one-way process. It's not an advisor going looking for clients. It's a client and advisor looking for the right match. That's a bit creepy, but it's sort of like a marriage, isn't it? Really,
it is
a marriage. It's not a marriage, a partnership. Yeah. But once that income tap has been turned off and the investments take over, the game changes.
Yeah,
and it's not wealth creation anymore. It's wealth maintenance, wealth preservation, wealth protection.
Right. Okay. The first time that you step out and you put weight on this resource that you've been accumulating your entire life can be quite daunting, right? Like when you've got that pot of money and you're now officially turning on the spigot and you're withdrawing and consuming that capital, it's a really unsettling experience. And I've seen a lot of people struggle with this, especially when they work so hard to build it up. What is the most efficient way for people to approach this? Again, I'm just trying to be mindful of this person who might be listening and watching, thinking, I need to make some pretty significant decisions around how I invest, who I trust, what my numbers look like, all that sort of stuff. But will this actually work? Is it okay that I spend this money? What would you say to that person?
Well, I think the first thing I would say is that you're not the first person to do this. So others have gone before you. Others have succeeded. One of the things I think is preparation. That's both administrative preparation and emotional preparation. So you've got to start to think about some of the issues. Now, I've been very lucky that I've been able to transition my retirement from full work to no work over a period of years.
Yeah.
And that means that the process has become a bit more gradual. And that's worked for me. It doesn't work for everybody. Some people like the cold turkey approach, but cold turkey comes with a harder emotional adjustment.
Yeah.
No doubt New Zealand Super helps because that gives you a
basic,
primes the pump, if you like.
Yeah.
I think from an emotional point of view, again, we've been conditioned for the first 60, 65 years of our life, which is a long time, to accumulate.
Yeah.
To save. When you were at primary school, you had a savings account, you got your pocket money and you put your money in your piggy bank. So it was all about accumulate. The turning point is when you start to decumulate, which says, okay, I've got enough now. I'm going to start taking some out. And you see the number dropping, and that's emotionally a hard thing for a lot of people. So, I don't like this to see this number going down. But why did you save it in the first place? Did you save it to hand on to the next generation? Did you save it to donate to charity? Or did you save it to give yourself a good life? And if you saved it to give yourself a good life, go and spend it. Go and enjoy it. But do it in an eyes wide open way. And this is where an advisor can help you, just to make sure that the balance is right, the numbers are right, the liquidity is right, the diversification is right, so that it's a stress-free activity, not constantly a feeling of guilt. Oh, I shouldn't really be spending this money, but I'm going to anyhow because that's the last thing you want. So guilt-free spending in retirement is the outcome that I think we should be aiming for.
That's awesome. Guilt-free retirement.
Guilt-free retirement, yes. Nothing to be guilty for if you've done a good job.
That's awesome. Thank you so much, Tony. I've learned a lot from you, not just in these conversations, of course, because you've imparted a lot over the period of time that I was doing some formal studies, so that was cool as well. But really appreciate the wisdom that you've brought to this conversation. I know a lot of people would have really got a lot out of this, so thank you very much.
You're very welcome, Darcy.
Cheers.
Cheers.